All right, it's 12:05, so I think I'm going to start. Can I have a little love heart from someone if you can hear me? Yay! Oh, so fun. Oh my gosh, I love this so much. They're like flooding the screen. Uh, so welcome to the State of the Strata Insurance Market, proudly presented by CHU. I'm Kimberly Johnson. I'm the CEO of CHU. It's been about 6 months since we've done this, so it's worthwhile sort of having an update because the world is moving very, very quickly. In the spirit of reconciliation, which is more important now than ever, CHU acknowledge the traditional custodians on the land in which we live and work throughout Australia and their continuing connection to the land, sea, and community. We pay our respect to their elders, past and present and emerging, and extend that respect to all Aboriginal and Torres Strait Islander people who are on the call today. First things first, got to tell you this is accredited for a CPD point, whether it's for ANZIIF or for the SCA. And so you'll get the certificates and the recording of this session will be available today. I thought I'd touch on the Strata Insights report that the University of New South Wales and the SCA produced earlier in the year. Probably have a look at the premium V claims that we've been tracking really closely. Have a look at the premium building blocks and have a look at the pool. The pool's interesting now because different than when we were first talking about it, we actually have policies in the pool now. So we actually know the effect of the pool rather than simply speculating. I guess other than this, I've got clever people in the chat. I can't see the chat, but there's clever people from CHU in the chat. So I think I've got Craig Stanley, Steve Cheepak, and James all in the chat ready to ask questions. So feel free to ask some curly ones while we're going. Get your money's worth on the from this webinar. So first, let's have a look at the market size. And what I see is some of the potential out of this industry, which I think, when we look at Strata, we know, we've heard Chris Duggan in the AFR sort of say it's a sleeping giant. And we know this, but when you see the numbers associated with this industry, it reminds us that we're all a part of something really big. So how many people have we got in Strata? So this is, thank you to my friends at the SCA. This is a lift and shift from you. So if any of you are there, thank you very much. And University of New South Wales. So this is a 2022 report. It was released in June 23. Some of you may have seen it, but I thought there's plenty of people who don't pick up a 69-page document. So I thought I'll pull out some of the exciting bits. We got 340,000 schemes in 2020. We increased 5% to 356,000 schemes. So that's not a giant increase in schemes, but we've also had a decent increase in number of lots as well. So we went from 2.8 million lots in 2020 through to over 3 million lots in 2022. Insurance people. Right. What do you think? So property value, when we talk about property value, this is the total aggregate of the building sum insured for policy one, I'm guessing. Now, it's gone up from 2020. It's changed to about 12%. So I reckon that's 5% in new buildings and 7% in some insured change. I'll tell you the number. It's 1.3 trillion. How many zeros is 1.3 trillion? Write it in the chat. I won't know if you get it right. So it's a 1.3 euros. So it's not a giant change from what we saw in 2020, but $1.3 trillion worth of property, that is a lot of insured property. And just simply the assets under management from the strata industry, but also from strata brokers, is unbelievable. We also, and I don't think I've touched on this in this presentation, the premium pool size has also grown materially. So in 2020, we're kind of talking about 1.5 billion, 1.2 to 1.5 billion dollars in premium in strata insurance. Well, that's now well exceeded $2 billion in gross written premium. So again, there's a lot of opportunity in this industry. But I think it's not just about the buildings and the management. There's so much more to strata these days than simply just insuring the strata buildings. And I think we should all, whether we're brokers or strata managers, be seeing opportunities out of this report, and a reminder of the opportunities we have beyond business as usual. So you've got 10,300 people directly working for strata management businesses. When I look at that, what I see is there probably has to be some opportunity for efficiency there. So if you've got less than 40% of the workforce directly working with buildings, are there opportunities there to reduce our non-core headcount? Are there opportunities there for outsourcing, for automation? If you are a service provider to the strata industry, like, is there a opportunity for you to be helping with outsourcing of strata management tasks? So there's a huge amount of work. We've got a lot of buildings. We don't have that many people, but there has to be efficiencies gained from what we do in strata. The next thing I see is opportunity for diversification. So, when we're spending $600-700 million on professional services, if I'm a strata manager, I'm thinking, either can I diversify my products into offering lawyering, valuation, engineering? Do you like lawyering? That's fun, isn't it? Legal services. So can we diversify what we do, or can we find a way to diversify our revenue through clipping the ticket type arrangements with lawyers, valuers, and engineers? With that kind of money being spent, there has to be value in the supply chain, and I'm sure a lot of it is currently untapped. If I'm an insurance broker, $7 billion worth of jobs. It's massive. So call out jobs, $7 billion, nearly 5 million call outs in 2021. These numbers are staggering. And so if I'm an insurance broker, I think strata managers, it's the same, right? Like, there's opportunities for diversification here into these services. But if I'm a broker, I'm thinking, what can I do around these trades? What can I do around having a scheme for people who are working in strata? Because there has to be untapped potential in that $7 billion. And you guys have the customers. You already know them. I was talking to a strata manager last week here in Sydney who has a large database of trades. They have 20,000 individual tradespeople listed on their database. Now, imagine what you could do if you had that kind of information at your fingertips. And so I think for me, if I was giving any advice to people running strata companies or running brokerages, I would be saying, what data do we hold outside of, simply that unit owner behind the door sales, which is a really I think we all know that that's the untapped part of Strata, but I think these trades and services into Strata are equally untapped by the broking market from the Strata specialist, but I think also probably through the Strata management side that there's more that can be done to partner with companies. And this is just like, it's the tale of sheer numbers. So about 10% of Australians are now living in apartments. 616,000 landlords in Strata, right? So 47% of Strata title units are rented out, 616,000 landlords. If I'm a Strata manager, if I'm a broker, I see a clear opportunity to be providing landlords insurance and other services. Again, you're getting call outs at that landlord level as well. I think just when I look at this, I think if you're on this call, you can only win. You're in the right place at the right time. And I think we are scratching the surface of the potential that can be derived economically out of Strata in Australia. I think one of the biggest opportunities that we have. So, we've been talking about diversity and inclusion for a long time. And we know that, diverse and inclusive companies do better than companies that aren't diverse and inclusive. So 47% of people who live in Strata don't speak English at home. That's a massive number. How are we communicating with these people? Like, our customers really are everyone in Strata. And I think in a lot of ways, most of us are really only catering to that 53%. And it's just a lost opportunity to not reach out and to not try and access that other 47% of people. I certainly don't have all the answers around what we do and how we engage with them, but I see that as the biggest missed opportunity that we all have. And I think from 2020 to 2022, lots of these numbers have changed, but this number is still big, and I don't think many of us have done much to reach out and engage with owners from non-English speaking backgrounds. Right. That's me on state of the market, on the market size, market potential. So if we just get into the insurance things, I'm going to show you some slides, which if you've been to the CHU symposiums, or if you've been to the state of the market webinar earlier in the year, you'll see some of the same slides with updated numbers. And I think the first one is probably the most telling. And this is the building cost inflation versus CPI. So your building cost or your building construction inputs are orange. Your CPI is the blue line, and the sum insured change for Strata buildings is the green line. So that's what we're experiencing. Now, it was looking pretty stark last year, and it was certainly, even in March, it was still a scary gap between the change and the cost, the building costs, and the sum insured change. I think it's pleasing to see that gap come up to meet CPI. We're not quite at the building inputs, but I think what we will see, not in Sydney today, it's raining, but as long as the weather continues to be good, we have this space where we've got trades available, we've got labour available, we've got materials available to us, and construction costs are coming down. Sorry, I was just checking if there was anything else I was meant to say. What's going up? So we've still got the claims inflation outstripping the premium growth. And this has been a year-on-year thing since the Strata price wars of 2015 to 2017. We're seeing sums insured go up, but we're not seeing the premium pool reach the rate of claims inflation. And the way that that actually plays out is in the premium building blocks, which we'll get to later. So we're chasing inflation upwards, but some of the gap is actually met by the increased excesses. So the premium growth would have actually had to go a lot further if the excess change didn't happen. This one hasn't been wheeled out for a while, this slide. So this is claims in La Nina versus claims in El Nino versus a neutral period. Now, La Nina is typically wet. El Nino is typically dry and hot. Neutral is where we like to be because you can see that when you're in a neutral period, the claims cost is significantly different than what you'll see in either El Nino or La Nina. Now, the worst thing that happens in Strata, cat-wise, is hail. And what you'll see is that in both La Nina and El Nino periods, the hail bars are big. So we saw in the 2019 summer that we had bushfires. Then we get 2020, January, you get your big hailstorm in Canberra. And so where we like to live is in this neutral space. Now, we probably got a few months in neutral before we are now entering an El Nino phase, which is a hot, dry summer. So again, it's we're hoping the weather stays good. So we're normally in neutral nearly half the time. We're in one of the extreme phases. La Nina is about 25, El Nino is about 27% of the time, neutral 48% of the time. We've actually had a decent year this year, and it would be great to see no catastrophes for the remainder of 2023. So while we're manifesting tonight when we're in bed, manifest no catastrophes for the remainder of the year. For the actuaries on the call, I apologise for that. So how do the cats affect the premium? So this is your long-term average claims cost per policy. So you can see there, your storm is a big part of it. Your hail specifically is a decent part of it. Cyclone, also a big building block. Earthquake, because we're dealing in big property, $1.3 trillion worth of insured property. The earthquake is still a big block, even though they're not frequent. Flood, I think we all know flood's localised. And so whilst it is not very big on this overall bar, what you'll see is that regions that are exposed to flood are exposed to a bigger average claims cost for flood. And bushfire is very small in Strata. Why do we think that is? Well, it's because most of our clients are in metro areas, and so they're not so bushfire exposed. So this is how we look state by state. So just to be really confusing, the colours have changed. Cyclone here is grey. Hail is yellow. So you can see New South Wales is extremely hail exposed. You've got the NT, Queensland and WA, very cyclone exposed. And Queensland has probably the biggest flood exposure. Now, if you break these things down into the Cresta zones, it becomes more extreme. Now, what I would say here is when we look at this, you can see those big grey cyclone bars for Northern Territory, Queensland and WA. And you don't see extreme cyclone bars in New South Wales, Vic or the ACT, for example. Now, Why do we think that might be? Put it in the chat. So it's that cyclone exposure as you come down. As you come down the country, the cyclone exposure reduces, and therefore the premium for cyclone reduces. Now, do we have customers in Victoria or Adelaide who are covered for cyclone? We certainly do. So it's one of the perils they're covered for, but their risk is very low. Just like we've got clients in Cairns who are covered for earthquake, but their risk is relatively low compared to some of the southern states. And so we look at what the pool has been doing, and we see that the pool is mainly providing savings up in Northern Australia. Now, there's plenty of modelling around cyclone activity. And so typically insurers have been working up in Cairns to like a 1 in 500 cyclone event. Now, the pool might, I don't know this for a fact, but the pool might be working to a 1 in 80 cyclone event. So basically what they're able to do is they're using less extreme modelling. And so I've seen people recently sort of saying, well, why aren't Sydney, when they are slightly cyclone exposed, not paying more premium towards the pool? And the reason that people in Sydney aren't paying towards the pool is because you can tell that a less extreme model has been used. So maybe a 1 in 80, and so it doesn't bring that big cyclone south. So it's good for people in Sydney, but it's actually also great for people in Northern Australia, because when we are looking at that 1 in 500 event, the worst still happens in Cairns. The worst still happens in Port Douglas. And so if we work to a more extreme model, the premium grows wherever we are. So yes, it'll bring premium down south to Sydney, but it will grow the premium pool, and it will actually dilute the effect that the ARPC have been able to have with their pool by working to a different set of standards. So we can't choose the model that we want down south versus up north. We've got to pick one, but I think the one that they've picked looks like it's working for everyone, and I'll show you what I mean in a minute. I'll go through this slide because I want to get to my rate stuff. So we've shown you over a number of years. So we've probably been showing this since 2016, 2017, that huge rate drop, which has affected our claims v premium trajectory. Now in 2022, 2023, we've seen really strong rate increases throughout Australia. Now, these changes have been targeted. So every risk is priced at its own address level. Oh, I've actually missed some information here, but what we're seeing here is we've put in a higher excess, which doesn't reflect in this rate change. So if we didn't put in the 2,000 excess, what you then have is rate continuing to go up. So we've been able to have a good impact on the premium change with the excess change. Now, this is absolutely no longer the whole story. This graph it basically now looks like it's telling lies, and I'll show you why. Because you'll have people in New South Wales saying that's not what I'm seeing, and you'll have people in Queensland saying that's not what I'm seeing. And it's because it's the average of extremes now. So Australia kind of looks like two countries. Who can tell me what might have happened around July 2023? July 2023 is when CHU policies start to go into the cyclone pool. So what you have is these northern states, Queensland, WA, NT, those big grey cyclone bars, all of those policies that had those big grey bars, the bigger the grey bar, the more impact that cyclone pool has had on their premium, to the point where we're seeing premiums on average in these states in the negative, even though when we look at Queensland, you've got southeast Queensland, which isn't as impacted as northern Queensland. You've got Perth that isn't as affected as Broome, but still the average of those states now has premiums going backwards. So from pushing really, really, really hard rate in those regions, to actually premiums going backwards. It's unbelievable. But it's actually also what we hoped would happen with the pool. You've got a different story in the southern states. So New South Wales, Vic, SA, ACT, Tas, they're just still pushing their solid rate change. Now, people are asking, being that it's October 2023, what's 2024 going to look like in terms of premium? And the answer is it absolutely depends where you are in Australia, because those northern states are going to keep doing what they're doing. And the southern states will continue to push rate. We don't think, with what we're seeing through claims inflation assumptions, that it's going to be as hard as what we've been doing in 22 and 23, but certainly I think we can still expect to be in double-digit rate increases in the southern states. Not as steep as they have been, but I think we'll still be plus 10, plus 12 certainly. But yeah, if I'm in Queensland, if I'm in WA, if I'm in Northern Territory, I'm very happy, except for if I'm an insurance broker, because my commission just went down. But I'm happy for my customers, right? So we'll just get back quickly to the pool, just in case anyone isn't aware of where we're at. So the pool is set up by the Australian Reinsurance Pool Corporation. They are trying to address availability and affordability of insurance in Northern Australia. I think what we can see through that rate change is certainly the affordability is starting to move. Now, I think CHU may still be the only ones in the pool, but once you get all the insurers in the pool, which it has to be by the end of 23 for large insurers and by the end of 24 for small insurers. So if you have insurance with anyone else, why would you? Hard to say. But what you can be expecting is to see these impacts of the pool come through from everyone in Northern Australia. And it's really pleasing to see. As for cyclone-related flood, home strata, small business insurance, commercial under 5 million, and it's for flood 48 hours after a cyclone. So that's where it becomes really difficult to delineate what goes into the pool and then what reinsurance do insurers still need to be buying, because it's not none. It's not no storm cover. So they're all still working that out. Honestly, I feel a bit sorry for them. The only other thing I would add is I would just stress that the Australian Reinsurance Pool Corporation is backed by a government guarantee, 10 billion government guarantee. They're not required to work to the APRA prudential standards that insurers are in Australia. And so that's why they're able to do these lower premiums, because they can work to different modelling. They don't have to be as conservative, which is working out for everyone in Queensland at the moment, I think. How does it work? I think a lot of people have seen this now. But so basically, you've got the building blocks of premium being your estimated cost of cyclone claim, your reinsurance cost for the cyclone claims and reinsurance for other perils, insurer expenses, margin, what we get paid, intermediary commission, and taxes. So what gets ripped out is the cyclone part of the premium, and it gets replaced by the pool. everything else goes back on top, but it's now at a lower base. And so then what that does is it makes this happen. It makes two countries happen. I'm very, very pleased and encouraged to see what's happening out of the pool. I know that there's been criticisms around the way the pool's been administered, and more could be in. You know, I think we'd all love to see flood in, but I think it's a good start, and it's achieving what was the initial intention for customers. And I can think of so many things where you get the government and regulators involved, where what they start out trying to do doesn't benefit anyone. And I think where we are at the moment is we're in a better place for customers than we were 2 years ago. On top of that, I think being that this risk is now reduced, I do think it will increase the availability of insurance as insurers become confident that cyclone risk is being removed, and they get to do that modelling around what's left. So everyone isn't confident at the moment, but I think they'll get there. So I think Northern Queensland, Northern Australia generally, WA, Northern Territory, I think they're a really good news story the last 6 months. So I'm going to wind it up. Thank you. I think if anyone still has any questions, quickly type them in the chat. If we haven't got to your chat, we will actually still respond to them after. Once again, certificates will be out next week, as will the recording of this. Hopefully they'll edit out all the things I said wrong. Thank you very much for coming. Thank you for your time. And just a plug for the CHU webinars. If you've got any topics that you would love to see us discuss, we're always open to more ideas about what we can do. So yeah, please put forth your topics, because yeah, we're very, very interested, and we want to talk about things that you're interested in. So thank you very much. We'll close it off now.